This is the Net Group Investments Insights Podcast, where one or more of our experts explore a variety of views and insights that investors care about.
Hello, I'm Trevor Garvin from Net Group Investments Multi-Manager. Today's voice note is entitled The Middle East Conflict, What It Means for Markets and Your Investments. Global markets have been dominated by a sharp escalation in the Middle East, following direct military conflict between the United States, Israel, and Iran. As investors, it's important to cut through the noise, understand what has happened, how markets are reacting, and most importantly, what this means for your South African and global portfolios. The current conflict was triggered over the weekend by joint US and Israeli strikes on Iran, aimed at Iran's military leadership and strategic infrastructure, including missile capabilities and command centers. These strikes followed long-standing tensions around Iran's regional influence, its support for proxy groups, and concerns over its nuclear and missile programs. The situation escalated dramatically after Iran's supreme leader, the Ayatollah Ali Khamenei, was killed in the initial strikes, a development that has fundamentally changed the regional risk profile and raised fears of prolonged multi-front conflict. The United States and Israel have been openly supported by several key allies. These include Bahrain, Jordan, Saudi Arabia, the UAE, Kuwait, and Qatar, particularly in providing defensive support and hosting US military assets. European governments have largely called for restraint, with the EU and United Nations warning of severe escalation risks, while Russia and China have condemned the strikes. Over the past 48 hours, Iran has launched missiles and drones at Israel and at US military bases across the region, including in Bahrain, Qatar, Kuwait, the UAE, Jordan, Iraq, and Saudi Arabia. Some strikes have also impacted infrastructure near major Gulf cities, disrupting air travel and energy logistics. While many projectiles have been intercepted, the geographic spread of the retaliation highlights the risk of a wider regional conflict, particularly if the Strait of Hormuz becomes compromised. This is a key sea gateway where 60% of the world's oil and gas supplies are transported from the Middle East to around the world. Financial markets have responded swiftly with a classic risk-off move. The VIX Volatility Index surged by roughly 25%, moving from the high teens to around 23 to 25, signaling a sharp rise in investor anxiety. Oil prices spiked sharply, with Brent crude up around 8 to 10%, currently trading at $79 per barrel, reflecting fears of supply disruption in the Middle East. Analysts have calculated that for every $5 increase in the price of oil, it increases global inflation by around 0.1%. Gold rallied strongly, rising more than 3% as investors sought traditional safe havens. Gold is trading at $5,400 per ounce. Equity markets have weakened this morning, with the US markets lower. The S&P 500 down about 0.4% and the Dow Jones down over 1%. European markets are also under pressure, with major indices such as the DAX, CAC 40 and Euro Stoxx 50 down between 1 and 2%. Although markets are in negative territory, they have not overreacted and are showing a more muted response. Currently, the South African stock market is holding up quite well, with the JSE up 0.2% as at midday today. Resource stocks are cushioning the market, with gold and platinum miners rallying sharply on the back of a stronger gold price. Names such as AngloGold Ashanti, Gold Fields, Sibanye-Stillwater, Impala Platts, and Sasol are among the stronger performers today. Financial stocks are under pressure, with banks and insurers lagging as global bond yields rise on inflation fears and risk appetite deteriorates offshore. On the fixed income side, South African 10-year government bond yields are around 7.9 to 8%, slightly higher on the day, as global risk aversion offsets the improving local fiscal dynamics. The rand has been volatile, but so far has shown relative resilience compared to previous geopolitical shocks, helped by higher commodity prices. The rand is currently trading at 16 rand and 7 cents to the dollar, holding steady over the weekend. The key macro risk is inflation. Higher oil prices feed directly into global transport, food and energy costs. This is inflationary in pressure due to higher input costs pushing prices higher. If sustained, this could delay interest rate cuts that markets were previously expecting from the US Fed, the ECB, and even the South African Reserve Bank. This would put additional pressures on the consumer, as opposed to rate cuts that would increase the consumer's disposable income. At the same time, prolonged conflict could weigh on global growth, particularly in Europe and emerging markets dependent on energy imports. For investors, periods like this are unsettling, but they are not new. The key principles remain. Avoid emotional decision-making during volatility spikes. Ensure portfolios remain well diversified across geographies, asset classes, and currencies. Recognize that quality assets, defensive equities, real assets, and inflation hedges often play an important stabilizing role in this environment. For long-term investors, sharp volatility has historically created selective investment opportunities rather than reasons to exit markets wholesale. In short, geopolitical risks tend to create short-term market noise, but long-term investment success still depends on discipline, diversification, and a clear strategy aligned to your objectives. We will continue to monitor developments closely and oversee investments in a prudent manner. With thanks, till next time, Trevor.
This podcast is for marketing purposes only. The information contained in the podcast or video was for information purposes and does not constitute advice, recommendation, or an offer or solicitation to purchase or sell any funds or strategies to any person in any jurisdiction in which the offer, recommendation, or solicitation to purchase would be unlawful.